Initial jobless claims coming in at 377,000. That is a decline from what we saw from last week, which was at 389,000, was revised higher. Continuing claims at 3.29 million claims. That is a bit above estimates at 3.25 million. So this is pretty much in line, Sarah, with forecasts and a decline, which may be a little bit of a sigh of relief for the jobs market.
But as you can see, Betty, futures are still going strong. Whether you look at the S&P, the Dow, or the NASDAQ, we're pushing up against almost 1% gains with S&P 500 futures. Remember, they got a big spike up out of that news from China cutting interest rates. That certainly helped the vibes this morning. No real change here on the back of those jobless claims numbers. Let's check, of course, on Treasuries is what you want to be watching with economic data. Unchanged on the 10-year and on the 2-year 10-year note yield, 1.66. Quickly, currencies, euro stronger against the U.S. dollar, dollar stronger against the Japanese yen. Solid economic data, solid risk sentiment out there on the back of that Chinese rate cut. Pretty much initial jobless claims, Betty, didn't do much to disrupt that trade.
Not at all. And in fact, there's still a lot of focus on what China did a few hours ago, Sarah. And Mike, give me your take on these jobless claims coming down just a little bit from last week.
Well, it's not just that they're coming down, but that they're maintaining a low level in the high 300,000s. The interesting thing about this is it comes just ahead of Ben Bernanke going up to Capitol Hill and probably going to tell people that the labor market remains weak. There are a lot of headwinds to growth, and that's why the Fed stands by to do something if necessary. The if necessary part doesn't get any help from today's numbers. Now, we are not only holding in a decent range. We'd started to go higher, but this pulls us back a little bit. But if you go back a year, we're much lower than we were a year ago, giving some credence to the idea that, yes, we're seeing the pattern repeat from the last 2 years of a fall off in the spring, but from a higher level that leaves us much better off and maybe not in as much need of stimulus as we were the previous 2 years. So it'll be very interesting to see how Ben Bernanke frames the labor market today.